Hello, everyone. Good morning. Thank you for dedicating this time to learn more about exit planning. Today, we're going to discuss what value acceleration methodology is, and hopefully, you walk out with a little bit more information on how to transition a business successfully with maximum profits. So, we're going to go ahead and move forward. My name is Sylvia Villarreal, and I am a focal point business coach and a leadership coach. So I work with teams and businesses and business leaders. And I am also a certified exit planning advisor in PMP and SBC. SBC is for safe, agile framework in incorporating and helping teams execute with agile methodology. And PMP is project management professional. I live in San Antonio, Texas, and I'm here to share more about what value acceleration is, which is a framework from EPI, Exit Planning Institute. So today, the learning objectives is we're going to be covering what is value acceleration, the benefits on focusing on value, in understanding the three gates of the framework or the methodology. What is a triggering event engagement in the two concurrent paths within the prepare gate and exit options. We're going to cover what it's in the book Walking to Destiny, written by Christopher Snyder, which is the framework that we use as CPAs, Certified Exit Planning Advisors. So let's start with value acceleration. What is value acceleration? It is a proven process that focuses on growth in aligning businesses, personal and financial goals to align the business owner to set up their business to be attractive and sellable. It integrates three legs into a master plan, and it is the business, the personal, and the financial goals. You may hear me talking about the three legs of the stool, and it is grounded in action. I love this methodology because that's what I love to do. I would love to work with leaders in teams to drive action and create great results through planning and working through with people. It promotes the use of teams and an engaging process with a roadmap for success, with key deliverables and metrics in order to get leaps in value of your business to be able to sell it with maximum profit. So what are the benefits and why is this important? Focusing on value makes the timing of the exit or transition irrelevant. That means we're always ready for when the opportunity comes. If someone comes in and say, I love your business because it complements my portfolio, I'm going to offer you more than what you're actually worth right now because it means value to me in my portfolio. If we're ready, we leverage a great offer. If we're not, they're going to pass us on. So it causes predictable results by working and executing the framework. It brings all those strategic goals into 90-day chunks. And this is what is similar to agile execution at a scale, enterprise scale format, because we constantly are reviewing that we're progressing every quarter through sprints to mitigate any risk and ensure that we are achieving our goals. It connects the goals to daily activities. So there is focus, where focus is very deliberate in what we want to accomplish, and acts as a driver for organization behavior. So the management in the teams understand how their actions and their work impacts the financial impacts towards the business and the value of the business based on their performance. The owner also ensures that family wealth are in the center of the plan. This could be a family-owned business or it could be an independent business, But the businesses that are personally owned and want to leave a legacy to their family members, this applies as well. That this framework applies. So it can be used as an intergenerational or employee development or transitioning or measuring tool. Because even if you don't plan to exit right now, immediately, there are going to be positive results in the bottom line. So this is in essence, the framework, the value acceleration methodology. There are three phases to it, or processes or gates, that if you have the book, Walking to Destiny, which I recommended because it talks about the whole framework, that I'm going to cover here in an hour. And so the book covers, and I will cover that. The Discover Gate is where it is recommended to conduct an annual business valuation. Many business owners do not know how much their business is worth. And things change, just like selling a home. It changes with the market and with the economy. So it is recommended to have a business valuation on the business once a year, and to also assess your personal and financial and business goals. So we do that through a trigger event in the discovery phase. The ultimate goal is to create a prioritized action plan, looking at risk, SWOT analysis, and determining the key milestones in order to move into the prepare phase. And we're going to be going over throughout this 1 hour and what it means. But in prepare, we're now more in execution mode in those continuous 90-day sprints. So the goal is to mitigate risk and bring the business to gain more value than it has currently. And when the owner decides, I want to sell, then we move into the decide phase. And that's where we bring, for example, M&A or a business broker to start the due diligence. But at that point, we will already have been prepared with the proof, all our documentation to assemble the proof, as you can see here, in a master plan. So it's practically putting the business in a situation where it's put in a silver platter, ready to be sold to the best offer. And that's ideally what we want to accomplish with this methodology. Why it is important? It is important at this point to start thinking about this because there are 73% of privately held companies in the United States that plan to transition within the next 10 years, representing $14 trillion of the economy of wealth transfer. And in the next 5 years, $9 trillion, because baby boomers are planning to exit. They're getting into the retirement age and planning to exit in the next 5 years. We are learning through research performed through the Exit Planning Institute that Generation X, people ranging from 43 to 58 years old, are thinking about retiring earlier than the baby boomers and accelerating that exit. So statistics performed recently, 2025, says that 57% of the boomers plan to exit in 5 years, and 39% of the Generation X, they want to also exit in 5 years. So a lot of business, private business, planning to transition. But what is our reality? Our reality is that business owners plan to utilize their business as a way of retirement because another statistic, 80% of the business owner's wealth, it's in their business. And 75% of these businesses don't have a business exit plan. And if they have a plan, some of them, they haven't done really the financial and estate planning that is retiring. So 25% of these business owners have not done any financial and estate planning that is required to really leverage and profit the fruit of their labor on their businesses to utilize it for retirement. So the probability is that these owners will not exit on their terms. They will not be able to leverage their situation if they're not ready. It's just like be ready for when the opportunity comes. This is what this framework is about. And why? Why also 5Ds? So the owner needs to plan for how they want to walk away from the business, not only in a perfect scenario, but also in a worst case scenario, because the likelihood that things are going to hit is high. And scenarios that often force exit owners to exit in a hurry and often leave value on the table are referred in our methodology as the 5Ds. We could be facing death, disability, a divorce, disagreement between partners, or distress. The 5Ds could cause for a business owner to leave value on the table, and we were trying to prevent that with this framework because it could mean millions or hundreds of thousands to millions. So what are the constraints in exiting or transitioning? Often for business owners that are not aligned to sell, they sell for less value. And they're unable to control the exit or pay too much in taxes. And that's what we covered, how to preserve wealth in the sale or fail to achieve the owner's personal goals or lack of owner's personal readiness. Statistics say that when the owner does not have a personal readiness plan to exit, often feel an identity loss when they exit their business. They're not ready mentally or financially. And this often causes for the deal to break at the end of the transaction. So when the personal readiness is not there, often private equity or third-party buyers might not be looking at the business as an attractive business. So we look holistically how to avoid these constraints. What is the difference between value creation business and its lifestyle business? A lifestyle business is when the owner is the business totally dependent on the owner to run the business. One example or one question that I ask my clients, are you able to go on vacation without touching your phone and your laptop? If the answer is no, that means you have a lifestyle business. And most of the time, it will lose about 75% of its value. We want to build independent businesses if we're thinking about value creation. So the business is attractive and transferable to an attractive buyer. If the business is not operating independently and needs you to run it on a daily basis, then it may not be sellable, or it might be 75% less than what you think it's worth. So let's cover gate 1. Discover. We're going to talk a little bit more in detail what it is. During this gate, there's a trigger event. And as part of the trigger event, we focus on the exit readiness. And there's an assessment that we complete in how we can increase the business value in the areas of risk so that we can de-risk it. We quantify the current valuation, where the business stands right now in the multiple in the market, to determine if your trade right now, if someone purchased your business, it's in the lower range or the best in class range. This more often will require strategic planning, looking at what are the threats of the business, what are the risks, usually a SWOT analysis, And as part of this exercise and the trigger event, there's a business valuation. How am I performing? Again, the multiple relative to the industry, identify the financial opportunity or strength. What is the need for personal and financial planning? And what is my strategic plan to get to best in class? So, again, as we covered before, annual business valuation, assessment of the personal, financial, and business aspects of the business to create a prioritized action plan. And with the focus of de-risking first and creating a roadmap with 90-day intervals to ensure that we're gaining value with each of those quarters. Also in the discover gate is thinking, again, the three legs of the stool, the master plan. How much do I need to retire? And how much is my business going to contribute? What are the rest of my personal assets so I can retire with the lifestyle that I want to retire? Or it might mean me selling the business to buy another one. What is my current multiple on this business? What does it represent based where it stands right now? And after we do the assessment, if we are in best in class, what does it represent in terms of value? And we're going to cover that. So as part of this framework, we determine what is the wealth gap? How much do we need in order to retire with our current lifestyle, or how we want to retire based on our current assets and the value of the business? We look at the value gap that we're leaving, the business value today that we may be sacrificing because we're not operating in best in class. What does that mean? And the profit gap is what we're sacrificing by not operating, also in terms of the profit and the EBITDA, by not being in best in class. And EBITDA is our earnings before interest, tax, depreciation, and amortization. And we use that in the multiple to determine how much the business could be purchased by an attractive buyer in this point in the market based on sales that are happening in similar industries. So also during discovery or the discover gate, we're just going more into detail in how we calculate the EBITDA and in order to determine that value, that range of value at this point, how much it could be sold for the business. We recast the figures from the income statement and the balance sheet. So I will work with your CPA and your financial advisor to determine that wealth gap, complete that financial analysis, and pull benchmarking data from the industry and to complete that enterprise value assessment, which scores the business attractiveness and based on the owner's personal, financial, and business readiness. And that will be compared to best in class. So we correlate those interview scores that usually take about 2 to 4 hours to complete with the business valuation and financial analysis. Deliverables as part of the discovery gate, there is the list based on those assessments. What is the list of the strengths and weaknesses to justify that present or potential value, and establish what is the value if we incorporate value enhancement? What does that mean? If the business is worth so much now, if we run it through the value acceleration framework, how much it could be worth once it's best in class. As we mentioned before, that prioritized action plan is created, and we're ready to implement it into 90-day sprints. To be completed, we normally have 3 to 5 personal actions and 3 to 5 business actions to get the business there, the personal readiness and the business readiness. So again, we're covering the trigger event, the creating actions, and delivering actions. So it's very value driven. And from gate one, we come up with a plan. And this is an example of a plan. What are the different activities and changes that or goals that we need to implement to get it there based on the scoring that we did on the assessment? And there is a roadmap that gets completed. So as long as the business owner wants to continue, we keep enhancing those gaps to bring more value to the business. This is just an example of items that need to be often addressed and how they're targeted in just like a project plan. This comes very easy to me because I've been doing project management, program management for over 25 years. So this is my baby. This is how I like to work with clients, getting them to a better situation based on risk mitigation first. Also within the discovery gate, we're covering a lot on what happens in the discovery gate, strategic versus non-strategic enhancements, and the risking that we've been mentioning. What are the unplanned events that we can be hit with? How is the insurance? How is the contingency planning, the backups, what tax savings? Setting the goals and developing that strategy is what happens in the discover gate, with efficiencies, growth in mind, and promoting a good culture and talent. You may see in some of my posting that talk about culture and team development and trust. This is how it applies to the exit strategy, and we're going to talk more about that. And why is mitigating risk so important to do first? Because it is the foundation. If you are hit with any of those 5Ds today, you still have value once we mitigate the most important risks. You will have value in your business. So we want to tackle those first. And some of the business actions is, okay, but is it management? How is your management set up? How is the employee situation? Is there training? Are they in the right roles? Do they have the right responsibilities? Is there customer diversification, or are you dependent on only one client that if you lose that client, it has adverse implications to the business? And are there metrics and dashboards? How is the customer service model? How is the inventory management? Financials, are they in order? What are the projections and systems and processes? And are they documented? Is there proof of what you have in the business? And again, we're trying to make it attractive. So an investor comes in and looks at, okay, all this is in order. I want it. I want it because I'm going to be able to just transplant it and make profit off of it, or eventually sell it in 2 or 3 or 5 years. What are the personal actions? Personal goals and objectives, the family involvement, needs and wants. Sometimes we think that we have needs or wants, but what is really what we want out of the business? Exit option analysis, tax savings implications based on the deal structure, and the development of the advisory team. We work with your advisory team if you have it, but usually there's consultations throughout the process from your financial advisor, your CPA, in order to calculate that wealth gap and look at the best options that will preserve your wealth after the exit. What is the life after the planning? What is the plan after the sale or the transition of the business? As I mentioned earlier, many business owners are really not ready to sell. And the due diligence happens. There's cost involvement, time involvement. So when an investor knows that these actions are not documented or planned, then the likelihood of them really going to the due diligence, it's going to be impacted because they don't want an owner that is going to have cold feet at the end of the transaction, and they have spent all this time and money on the due diligence to then for the deal to break. So this is something that needs to be considered for the business to be attractive and sellable. So during gate 2, we prepare, and this is where execution happens. The planning, the personal and financial planning, and the business improvements. And as part of that whole process, we assemble proof that will help for the due diligence. So in a master plan. So the intention is to be ready again for when the opportunity it presents itself. So during gate 2, again, all the planning and one question is what personal purpose is the business serving and how do I replace that? And this comes to the personal planning of the business owner. Can I achieve my personal objectives without my income? Am I confident I will be financially secure? So that's where we bring in your financial advisor, or I will help you find someone at no cost to provide this advising. Who depends on me? Who can I help? Many owners want to leave to charity some of the profits or leave their legacy to the family. Questions that are often asked, can I state how do I project my health to be in the next 3, 5, 10 years? What is my contingency planning and insurance planning? Do I have a partner? Do I have a buyout agreement in case if something happens? How our family is going to be surviving? So needs and wants and estate planning and tax planning happens in the prepare state or phase. And also during this phase, we look at the 4 C's that drive value. During the assessments, these are accounted for, but our intention here as we're executing and removing the risk and implementing the goals to promote value, we look at the 4 C's that drive the multiple to become best in class multiple. And so we covered about de-risking the business. That way, if something happens, you still have your wealth preservation at this point. But then we start looking at the 4 C's that brings us to the best in class, which is human capital. How is the governance in the business? How is the team building? The skills of the team. Are there anything that makes it so attractive because of the skills of the team, or are there patents, intelligence that could make the business extra attractive? It's part of the human capital. The structure. Are there systems and efficiencies in how the business operates? Is your CRM totally organized, or are there improvements? How is your IT? How is your IT and customer service working? Are you benchmarking? Are you looking at metrics in that proof that you are best in class? The other aspects of the 4 C's is the customer. The customer, are you looking to expand? Do you have repetitive or recurring models or maybe contracts with customers and clients that make the profitability predictable? And the last one is the social aspect, is the organizational culture. Often investors, if they see that the culture is not there, how the teams operate, the synergy, the management, and the the front end employees, and lack of communication, lack of trust, it will impact the value of the business. So again, as a coach, as a business coach, I work with teams to bring that social culture to be optimal from a communication, from a trust perspective, from mental fitness, from emotional intelligence. Going back to why the four C's drive value is, for example, the EBITDA, as we talked about. Let's make an assumption that the EBITDA is the same and the current multiple is a 2x in the industry. So that the business will be valued at 2 million. But on the other hand, if we bring the business to be best in class, to be a 6x multiple in the industry, a business that meets the four C's and is de-risked, and then the value could be $6 million. So it's the same thing. It could be $20 million, $16 million. So the framework applies for a small business in a middle market or a high end and higher in terms of the earnings. And it also applies, we use the discretionary earnings as well for a small business. But the concept applies, and this is if EBITDA or earnings remain the same. But as all these four C's are implemented, the likelihood that the profits, the bottom line, will also increase. So we're going to be seeing improvements in the EBITDA or discretionary earnings plus the multiple. So the improvements become exponential. As part of the prepare phase, as we mentioned, we assembled the proof with the mindset to be organized and ready. And the data should be updated periodically every quarter to, again, if the offer comes, we're ready. It's comparing it to when you want to sell a house. We want to keep it in the base that possible to get the best out of our investment, right? We may have done maybe some remodeling in the kitchen or in the bathrooms because that's what drives a lot of value in a home. The same thing here. We want to keep it ready for when an offer comes. The master plan, again, focuses on value rather than income. But as we applied all these four C's, your income will increase naturally. Integrating the three legs of the stool, as we mentioned, the financial, personal, and business readiness, putting the owner and the family at the center, ensuring that the family is good with all the actions that are happening. Promotes team play or team collaboration through the whole process through workshops. It is measurable. Both the advisors and the employees understand what's happening and what actions need to be taken in order to increase value with a clarified roadmap, with clear accountability and clear deliverables by everyone that needs to take action in order to de-risk and meet the goals to promote value. At the prepare gate, in summary, we develop a 3 to 5 year action plan. Ideally, the sweet spot to work with business owners is 2 to 3 years. The more time you have, the more value your business will accumulate. But when the business owner is ready, pull the trigger, we move into the next state or the next gate. But in the prepare gate, we're focusing on 90-day sprints, very focused, very deliberate, assigning actions to the teams with accountability. Now, that's my strength to working with teams, promoting accountability to drive results. And it takes committed resources, but that's where I work with the client, with the business owner to structure that. Establish a measurement and feedback process, define a communication planning rhythm, and revisit every 90 days to ensure that we're gaining value. So now we come to gate 3, which is the decide gate. At this point, the owner will decide, do I want to keep growing value in my business or am I ready to exit? And during the whole process, having different advisors at different times when needed, we talk about the different exit options. So by this point, the owner should know how they want to proceed. Do they want to do an intergenerational transfer, which means they will leave the business to the family? During the whole process, we analyze, are the kids or the kids that will take the business or the family members ready to lead the business? And if not, what actions we take? Is there going to be a management buyout? It is the sale to existing partners. That's another option. The sale to employees, and that's our inside options. Outside is a sale to a third party, which often brings more money to the table. It could be a recapitalization, IPO, or orderly liquidation. The owner will drive, but my responsibility, as what I'm called in this framework as the quarterback, I partner with different advisors. It could be the current advisors of the business owner. And if they don't have the advisors, I will find advisors that come as part of my team to drive them through the process to select the best option that will create the most wealth and wealth preservation after the sale or transition. So also during the last gate or the third gate in the decide it's a major point in it. If we decide to grow, they would proceed to grow. If we proceed to exit, we start doing more of the due diligence, bringing M&A, depending on the value of the business, or business broker. So we're also assessing the market timing, the business life cycle, and the personal time chart. All those are decided in gate 3. We discuss the sales strategy and explore other transition options if the market is more favorable to one versus another. We also talk about the risk reward, the advanced value acceleration, which is a 2 to 5 year commitment. If the owner decides, well, I could sell right now, or I could keep growing, and they will be, if they continue to grow, there will be some complexities that we need to account into those 90-day sprints. And but the reward is usually a 3x increase in value, sometimes 4 to 5x into the business value. But we expect, as a business grow, expects complexity. So as part of that, we account for the goals that need to be addressed during the 90-day plans. If the decision is to transition, then the exit options are the focus now. And the wealth preservation. What is the best option? And the plan now changes. That roadmap now focuses on the transition plan or exit plan. So all this is done on the business owner's terms. That's what we want. We want to have a plan to give that to the business owner and not have to sell because of one of the 5 Ds that we mentioned before, to maximize wealth and also to preserve that wealth, to ensure that it's according to their terms. If they're planning to retire or buy other businesses, but it's on their terms. It is a collaborative approach. I come in as your CEPA, your exit planning advisor, but I have a team of trusted advisors that I can recommend or work with your own advisors that you trust. For example, your financial advisor, your CPA, estate planner, to give you the best option for the exit of your business. We worked to assist business owners in their exit planning, plan it the best way possible. We define roles and responsibilities in the whole process. And we take the owner through the different gates until they decide to exit. So please think of us as your business development resource to maximize your wealth and your wealth preservation in the process. So again, my name is Sylvia Villarreal. I'm a SEPA, exit planning advisor, executive leadership coach, PMP and SBC. I feel very confident that I can help any business succeed. If you have any questions, please reach out. I'm sharing here my website, my email. I invite you to take an exit readiness score and schedule a 20-minute conversation so we can talk further about your wealth preservation. Thank you for joining me today. I hope I presented something of value in knowledge about exiting or transitioning your business. So thank you for your attention today. I appreciate it.